evening and welcome to Money Matters. My name is Jim Butler with FourFront Advisors. My co-host tonight is James Chan with Asia Marketing. Welcome, James.
Thank you. Well, thank you. Good to see you, Jim.
We're going to have a very interesting conversation this evening.
I hope so.
That's before we even get to the guest, who's
Right.
really going to bring some hot topics to the table, given the timeliness of our conversation. But let us start with the 800-pound gorilla in the room. And even though we don't want to time the taping of the show against when it's going to air, certainly the coronavirus situation is going to take a while to clear up.
Oh, yeah.
And you in particular do business with folks and businesses in China. So what is your take on the current state of things and the outlook?
Well, I mean, it's going to be a grim picture, to be straightforward, because there's no point to even hide anything.
Right.
The people in China are still pretty resentful against their own government in terms of the government not willing to admit something amiss happened. But, and even in terms of U.S.-China relations, I think that even before the virus came about, it was not in the best of shape. So I can foresee it's going to drop even more. But in any case, to me, without wanting to be optimistic or too positively just being somebody who wants to talk up a game, I still think that the virus will pass. It's one of those, like people say in the Bible, this too shall pass.
Right.
And maybe, hopefully in a year, 2 years, hopefully not that long either, things will go back to normal. And I think people want to fly again, people want to see one another again, because right now we can't even go to China if we want to. And our customers don't want to see us, even if they continue to buy our products. Luckily, we still continue to get orders, well, because of the 30-some years we put in marketing our products there. I help companies sell the products, their products, American-made products to China.
Okay. And then do you help import Chinese products into the United States?
Only in my 39 years of doing this, only in 1.5 years I did that. Because that was during the Tiananmen incident, remember 1989?
Yes.
And the students in Beijing were protesting against the central government for nepotism, for corruption. And then there was a period of 2 years when basically America and China were not doing much business. But at that time, business was allowed, so most people, most companies, instead of trying to sell to China, they would buy from China. That actually was the beginning of the whole import from China phenomenon. It began there.
So fast forward to not only today, James, but going forward, say 12 months, 24 months, what impact do you think the coronavirus will have 12 months, 24 months from now?
The moment they find a cure, a vaccine to it, I think people are kind of like teenagers. Suddenly they are of age. They will start drinking like there is no tomorrow.
Okay.
There will be that moment. It's almost like after the Great Depression, particularly after the Second World War. Everybody started to buy everything they could get their hands on.
Right.
I think that there is that comeback boom, which it's difficult to say right now.
Sure it is.
Because the condition is not propitious.
I was listening to a chief strategist by a major financial institution very recently, and he made the comment, without the details, he said that 2020 was going to be the year of the virus and 2021 was going to be the year of recovery. Now, he wasn't putting a specific timeline on when that change was going to occur, other than in agreement with what you just pointed out, which is in the short term, we still have some waves to go through before things start to smooth out. But on the other side, there seems to be a fair amount of sentiment from folks that we're talking to, those that I listen to and read, that once we get beyond the storm, that things will return to normal. Do you agree?
I agree, because even now, even though we can't fly to China and we have stuff we need to ship Normally, we ship directly by air to Chinese airports. Now we can. We have to ship them to Japan first, to South Korea, and then transship there. So there is a disruption even in the supply chain, even for exporters like us. And so this is going to take, I would say, 2 quarters or more. Knowing that how American businesses go from quarter to quarter, we don't go from 5 years to 10 years to 15 years.
No. Right. Well, that may be a good thing in this case. Let's use that to look at our question, because we have a viewer. In fact, Janice Thomas has written in, how badly will the coronavirus affect China's business with the U.S.? Now, you touched on that, but would you answer that question any differently?
Well, I would say that the immediate future is likely to be very difficult, pretty grim, actually, because if you keep in mind that even before the virus took place, our exports to China dropped 17%. And Chinese investment in America dropped 80%. So those numbers are going to go down even more before we see them coming back. And the ray of hope is, just yesterday or 2 days ago, the president of China, Xi Jinping, Mr. Xi, was actually brave enough to visit Wuhan. Now, for him to visit Wuhan,
is that a big deal?
It does say that people thought, the physicians thought, because right now all of China, this is an inside piece of knowledge, all of China is pushing their best and the brightest physicians to go to Wuhan to work on this. So they are not going to easily let a political figure like Xi to go there. So they feel that it's safe, because so far 80,000 people in Wuhan have been infected from the beginning, but 60,000 have recovered. 60,000 out of 80,000 have recovered. And yes, 3,000 people died, so the death rate is close to 4%. But the fact that 60,000 people have recovered tells me, it's not, the fact that you get it doesn't mean that you will die.
Right.
Granted, 4% is still high.
Right, so, Sure. And one other thing that I happened to look up this afternoon, and that was historically, without, again, all of the details, but using the U.S. equity markets as a barometer, there's always been a bounce back period normally. If we look back into, the Zika virus back in 2016, Ebola back in 2014, MERS in 2013, swine flu in 2009, just to name a few. 6 months after when those contracted, there was a return, again, within the broad index of U.S. companies, up over 8%. So in other words, from the beginning of those incidences 6 months later, the U.S. equity market was ahead by about 8%.
In other words, panicking is not the best policy.
It's not, nor, going back to what you said, to put any kind of timeline on this, because we can't do that.
We can't.
Yeah. So thank you for writing in, and if you would be interested in sending in your question, please do so. We'd love to hear from you.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.
Welcome back. Today's guest is Sam Silverman with Markham Accountants and Advisors. Welcome, Sam.
Thanks, Jim. I'm glad to be here.
Great to have you. Again, we don't like to time when we tape this versus when the show gets aired. However, we are in tax season, and
Yes, we
one
are.
could say we're always in tax season.
Yes, it's crunch time right now, but maybe there's instead of focusing on taxes, focusing on the markets, and the coronavirus seems to be everyone's focus more so than taxes, as I speak to all of my clients.
Right. Right.
But it's here, and just today or yesterday, the President and Congress, they're hinting that they might extend the due date, the April 15th due date.
Oh, interesting.
I didn't hear that.
Not only for
Interesting.
filing, but for payments as well.
For how long?
Don't know.
Okay.
Yeah.
All right.
Not that I would want to extend tax season, but it might be good for my clients.
Right, right. Well, just to build some or establish some credibility, spend a minute or less, Sam, on your background and how you've come to partner with Markham.
Sure. CPA, I went to school in Philadelphia. I grew up here, and I had a small accounting firm in the suburbs, and merged into Markham January 1st. Everyone from my firm came into Markham January 1st of 2019. Markham is a national accounting firm servicing about 30 offices around the country. It's been around since 1951, a New York firm that expanded, and we have an international presence, six offices in China. It's an association with a group in China.
Interesting.
Since that
Very
was,
good.
yeah,
very
that's
good.
the topic. And Markham has clients, public companies, down to the mom and pops with tax and accounting needs.
Right.
So it's the full spectrum of services for any accounting firm. Markham is the 15th largest accounting firm in the country.
Okay.
It's the 8th largest in Philadelphia.
Okay. So given that, certainly you have spent your career in the tax field working with individuals and business owners. So just as a starting point, can you touch on a couple highlights from the Secure Act that was just passed last year?
Sure. So the big part of the Secure Act that I'm sure you're seeing this with a lot of your clients is the elimination of the stretch IRA,
Right.
whereby you inherit IRA monies from mom and dad, kids, and previously you could take money out, the required minimum distribution,
Right.
over your lifetime.
I was about to ask you a question later about the distribution, but please go ahead.
And now you need to take the money out within 10 years.
Within 10 years.
Within 10 years. So that's a change, and they raised the 70 and a half year or line in the sand when you have to begin your required minimum distributions
Right.
to 72. They moved that up a couple years. There are some other little points to the Secure Act that passed, but those were the major issues.
Okay. All right. Do your clients, the clients that you work with that are impacted by that, do they understand that and does that seem to benefit them? Or does it actually work against them?
Well, it works against them with having to take the money out if you're a beneficiary of an IRA and whereby you would have to take the money out within 10 years, you're just paying taxes a little bit quicker.
Right.
And you don't have the money with a good investment advisor whereby they could defer all those gains for all those years until you could take it out later.
Right, right.
So.
But the age 72 to allow
That's
folks
helpful.
to make contributions gives somebody who's working longer an opportunity to maybe.
And it
continue
delays
that.
the required minimum distribution on your IRA monies
Right.
by a
So
year and a half.
You think for people like me, because I'm exactly 70, and I know that in about half a year, according to the old regulation,
You got
I
2
would have.
years now.
Yeah. So really, is it a big deal? Really, is it?
Little. It's just when you can have more money in your pocket, it's always a good thing.
Yeah, but what if I really don't need that money? Then I'll put it in the bank and I get 0 interest. And what?
That's a whole other topic that we could talk
I
about.
understand.
But really, what I'm dealing with more, Jim, is just all of our clients trying to understand all the new tax laws that impacted everybody in 2018. Certainly, it hit the accounting world, whereby it was all new. It was the biggest overhaul of the tax code in 30 years, since 1986. And it was a little confusing. There was some a learning curve that all CPAs had to go through. And there's it's good. There's a lot of strategies that you could use to reduce your tax bill,
Right.
but it's still taking time to understand it. And certainly all of our clients are having some difficulty understanding it, and it's just a constant reminder of these are the certain things that you need to do with the new tax laws.
Right.
Is there a new rule or regulation that is a true boon to people with
James,
capital?
great question. So most people have heard on the news that they lowered the corporate tax rate.
That's
The
right.
government lowered the corporate tax rate to 21%. Oh my God, that's great, 21%. But that really only impacts C corporations, which are mostly public companies. So what about all the flow-through entities, the S corps, the LLCs,
Right.
which represents probably 80% of the employers of our entire workforce?
You mean mostly small businesses?
Mostly
Right.
small businesses.
Yeah, but- okay.
So they're all flow-through entities. So for the first time in the code, there's a reduced tax rate, or what's called a qualified business income deduction of 20%, that reduces its reduction of the income. It's a deduction whereby those flow-through entities, if, for example, you make $100,000, your business makes $100,000, you're only going to pay tax on $80,000. There's a 20% qualified business income deduction.
Okay.
Or you could think of it another way, it's a 20% discount on the tax
Right.
rates.
Right.
So not only did all the tax rates for individuals get reduced with the new tax law, top tax rate was 39.6, now it's 37. 28% bracket is 25%. 25 went to 22, 15 went to 12. And if you think about that, 15% going to 12%, that's 20%. That's 3 points on 15%.
It can be real money.
It's real money. So all of the rates were reduced 10% or more, and then on top of that, you have this qualified business income deduction of 20% further reduction. So for a flow-through entity, before the tax law changed, the top tax rate was 39.6.
Okay.
Now it's 37 minus the 20%, it brings it down to 29.6. So back to C corporations, 21% for all the public companies. Well, all of these mom and pops, and the mom and pops could be this big, or it could be $500 million in
Sure. Yeah.
revenue. It's 29.6. So that's a really good thing for all these flow-through entities. Now, for the most part, my clients, which are manufacturers, there's some service, it's a wide spectrum, retail, when they have a little bit more money, meaning that they're paying a little bit less in taxes, they're using it primarily for working capital, expansion of their business, maybe hiring
Are they really
employees.
expanding? Do you know for a fact?
No, they are. And an expansion doesn't have to mean acquiring another business or acquiring another plant. It just could mean buying that piece of equipment that
Okay.
you didn't have before. You know, just expanding your manufacturing facilities somehow with equipment in many different ways. So I think there was a lot of good things about this tax code that helped a lot of people. And it's not just the business owners. People making $50,000 a year, they're saving a lot of money as well, because not only with this qualified business income deduction, but the standard deduction. So remember, you can itemize your deductions,
Right.
or you can take the standard deduction. The standard deduction doubled. What was $12,000 now is $24,000 for a married couple. It's now $24,800 or
800,
something.
something like that,
Yeah,
right.
yeah.
But in addition, if companies aren't expanding, as Sam just pointed out, what we're seeing is that companies are making a more healthy profit-sharing contribution to a retirement plan. And when they do that, everybody potentially benefits.
That's a really good point, Jim. That is absolutely correct. During 2008, 2009, 10, and going forward, geez, I've had clients where the employees didn't have raises for years.
Yeah,
It was really hard. And now things are happening again.
right.
They're
right.
earning a little bit more money. The company has a little bit more money.
So here's something that I hear once in a while, not frequently, but it does come up, and that is I deal primarily with the retail client, husband and wife or families, small business owners, but they're always, I mean, we're all paying personal income taxes. The feeling is in some cases that they're paying more in taxes now than they were before, even though they hear what you just said as far as, well, tax rates are lower.
Yeah.
Why do I feel like I'm paying more?
Yeah.
There seems to be a disconnect, and I don't know if that's the media at their work again, or if it's simply not a complete understanding.
It's a little bit of both. That's a really good question. So the really high earners that live in high tax states, New Jersey, New York, Illinois, California, and they're paying a lot in state taxes, they're paying a lot in real estate taxes. State and local taxes are now limited. You can only deduct $10,000. So if you have a wealthy individual paying a lot of state and local taxes, they really got hit hard. And there's something called alternative minimum tax that all of my clients, when I said, well, you're paying this AMT tax, alternative minimum, they said, what's that? So, well, your tax return's computed the regular way and then with alternative minimum tax method. Really? I never knew that. And it's been in the code since 1986. So that AMT tax pretty much went away, and the one item that put a lot of people in that AMT bucket where they paid this alternative minimum tax was that state and local taxes were not deductible under that method. It was an add back. So many of our clients were paying AMT, where they're paying a higher tax because of alternative minimum tax. So with the new tax law, that's pretty much gone. Mm-hmm. So when those clients think, well, I'm not getting the deduction for state and local taxes, I said, well, in past years, you were paying alternative minimum tax. You weren't getting any deduction for it. Now you're at least getting $10,000.
Right.
So I do think that the really high earners paying a lot of state and local taxes, they did not pay alternative minimum tax in the past because their regular tax was so high.
So
They got hurt. But someone earning less than $100,000, I don't see how they're paying more money with the new tax laws.
Right.
So, in a very simplified manner, you're saying that the newest tax code actually is more harsh on people with a lot of money compared to people who make less than $100,000.
High income versus middle income is
Right,
probably
high
what you
income
know.
James, not entirely, because if you listen to the debates, Elizabeth Warren wouldn't say that, and Bernie Sanders wouldn't say that, and they're right, because earlier I spoke about all the tax rates being
Right,
reduced.
yeah.
So those really wealthy individuals, they were paying 39.6 at the highest rate.
Okay.
Now they're paying 37. Okay. So that 2.6% difference on most of their money makes a huge impact, much more than the state and local
Gotcha.
taxes. But the people in high tax states, there could be that bracket, and I'm just making up numbers, between $500,000 and $1 million, where they are paying a lot more.
Okay.
Because they don't have that deduction.
Okay.
But it depends on everyone's situation. Think about someone earning $50,000, and now a married couple, they have a $24,000 standard deduction.
Mm-hmm.
I don't think they had itemized deductions to exceed that in the past.
Mm-hmm.
So tax rates reduced and a higher standard deduction. So now we're only talking about income tax. There's other taxes, there's
Right.
Social Security taxes and everything else.
Sure.
But if we look at the income bracket between, just ballpark a number, $100,000 of adjusted gross income to $500,000, it may go either way with them, but more than likely they're not paying more in income taxes.
Probably not. And just the feel I have, maybe 80% of my clients save tax dollars in 18 as compared to 17. And that's from $50,000 to millions of dollars of income.
I just have a nagging feeling that, like engineering, in taxes, it all depends.
James, it all depends, is right.
It all
because
depends. Everyone has to have a strategy.
And if you have a flow-through, have a
Right.
flow-through business,
Right.
as a business owner, you're saving with that qualified business income deduction, that extra 20% haircut on the rate, so to
Right.
speak. And think about this: if there's a married couple and they have a side business, They make $20,000 doing whatever else they're doing. They're a sole proprietor. That qualifies too. It's any flow-through business. It's any business like that. And there's limitations. If you make above $326,000, there's other triggers that you have to that kick in, and 326,000,
okay.
and then you have to have some other factors, which we don't need to get into, but it's pretty good.
Okay.
So one more question as we wind down our time together this afternoon or this evening, and that is, you made reference earlier about the Tax Extender Act. I'm not sure that's the official name. That's just a name. In other words, what was passed in December. And was that something more or less what you alluded to before?
No. So the Tax Extender Act, there's certain aspects to the code that Congress just says, okay, let's extend it for one more year. They can't make a decision, so they just extend it. And there's a bunch of this stuff every year.
Okay.
So December comes around, they're busy doing whatever, and they have to decide what to do with all of these issues. Like, for instance, one was medical expenses, to the extent that you have a certain amount of medical expenses where it would be part of your itemized deductions. The medical expenses would have to exceed 10% of your income. The old law was 7.5. They changed it to 10. Well, they brought it back down to 7.5, and that was part of the extender bill.
Okay.
It was really not much in there, just little stuff like that. So you'll see at the end of 2020, there's going to be some other extender with a whole bunch of stuff in there.
Okay.
So
people really shouldn't get too confused when that sort of stuff happens.
That's why they need accountants.
Right?
James, you're good. Thank you. But on the business side, there's this bonus depreciation if you have a business, whereby you can pretty much buy equipment, and you could, when you hear on the news that Amazon didn't pay any taxes, it's because they're buying equipment, they're investing in their business, because all of that can be deducted in the year of acquisition. Whereas before you'd have to depreciate it over time. That's probably one of the factors why.
Great. Thank you.
Thank you,
We could
Jim.
keep going.
We could.
Yes.
But people get bored with this after a while. There's
Well,
a limitation to tax.
That's okay, and they hire you,
Yeah.
Good.
right?
Yeah.
So thank you for listening. Hope there were a couple things that were beneficial and of interest. Tune in next time. Our guest is going to be Charles Robbins, who's a managing partner of Fairmount Partners. They're an investment banking firm serving the middle market. Again, we hope you've enjoyed the show and look forward to seeing you again.